I've taught for 30-some years at a university. I'm Bruce Sherrick, a professor at the University of Illinois, and run a farmland research center and do some other fun things. We build crop insurance models and build cool things for, just lost my mic. Build capital models for banks. Is it back on yet? Is it okay? Okay. And, but mostly teach, and that's really fun. And I've noticed that the switch to hybrid and online is a really complicated thing. If the people are in class and you tell a joke, they laugh and they try to stay engaged. If you tell a joke, all the people online don't laugh at all. And my daughter says that's because I'm not remotely funny. Oh, good. I like to know what I'm working with here. Okay, today we have a really fast presentation that does three things. One, on your table today, you got a National Land Values Report that had really good historic data and present data about how farmland has performed as an investment all around the country. We track in the NCREIF regions. Our group at the University of Illinois helped design NCREIF. Wow. And now for our subtle presentation. Hey. We good? Okay. Thank you, thank you. If you'd walked in with candles, it would have been different. So we keep track of National Council of Real Estate Investment Fiduciaries, all of their investments. It's about 13 billion. And we keep track of all the state level data, and we've developed a system at our university for about 50 years now of having farmers report their actual production records and their financial records in the state of Illinois, so we have a really good data system. What I want to talk about today is sort of at a three-level thing, though. Because you have the book, there will be a lot of reference to that. Again, it was at the tables. It's just called National Land Values Report. See a few copies of it around. And after that, though, I want to talk about why we've seen what we've seen in the last couple of 6, 8, 10, 12 months. And then think about processing the macro information that we're seeing register and think about what that might mean going forward. Again, thanks for being here in sunny Iowa. I know that it's a destination all to its own, so you're probably wanted to come here anywhere in the middle of January. So, okay, so farmland in the last 6 to 12 months has really skyrocketed in value. Iowa State's survey says Iowa's gone up about 28%. Illinois is probably mid-20s. Again, this is transaction value. That doesn't mean all land went up the same amount. There is a selection bias. Land that comes to market is more likely to be the ones that the parcels that are more likely to sell well. So it's not saying that all land is worth that much more. But I want to try to put some context around why this has happened, try to predict a little bit about what's going on in the future, and then talk about some of the really big things. You can't have a farmland conference without talking about carbon and talking about climate and so on. So we'll put a little of that in it as well. Background questions. In the last year and a half, 2 years now, we've developed this kind of response to everything that involves additional monetary or fiscal support. And they're different, of course, but we'll lump them together for a minute to say people have had support of their spending and support of their income if they were disrupted by the pandemic, or if they were disrupted prior to that by trade wars, or disrupted prior to that by production disasters. The 2019 flood in the upper Midwest generated massive crop insurance payments. So everywhere you look, there's been something to de-risk the downside in agricultural income. Is that going to continue? How long is it going to continue? We've clearly gotten to the point where the interest rate interventions are coming to an end at some pace. The Fed has announced their tapering plans. The Fed has published dot plots that moved a little bit more. So we know it's coming, but we don't know quite how fast or what the impact will be. Secondly, inflation is definitely here. Whether it's transitory or not, we talk about the toilet paper effect versus the eating out effect. If you got to the beginning of the pandemic and bought a bunch of toilet paper, it doesn't mean you use more. It's just you acquired it sooner. So what you do later will offset that. But the times you didn't go out to eat at a restaurant during the pandemic, you're not going to go out now and eat 3 lunches tomorrow out at a restaurant because you skipped 2 others sometime during that last period of time. So we have to find out what the lost production was, how we balance that out with payments, and whether they, on balance, become inflationary or not. I think it's becoming pretty clear on that. Increased commodity prices. So farmers had a little extra money in their pocket. Folks who were on the fence about selling brought their land, in some cases, back on the other side of the change in the calendar year, concerned about tax law changes. So we had kind of a perfect storm. A little extra supply, a little extra demand, and it registered. It really did. Now, I don't expect the long-term turnover rate to be sustained by that pace that we saw in the last, fourth quarter. Historically, fourth quarter and first quarter are the big turnover periods. We're not going to keep up that pace, no possible way. And these are available too afterward and online, so if you don't want to take pictures, we'll get them to you. But it looks like on a world basis, the demand for improved diets, what happens, and I have some charts to support this later, as your income goes up, you want to eat more meat. You want to eat higher quality proteins, and if you look at the share of the world that is growing into a better diet, the number of calories you have to multiply up to feed an animal before you consume meat is much higher than if you have a more subsistence diet and are eating just the grain directly. That's actually very positive long-term for the U.S. The question is, where else will we grow grain around the world? Ukraine and areas north and west of Ukraine and parts north of South Africa. There are some other parts of the world that can bring more land onto production, as well as parts of South America. So, land, buy it, they ain't making no more of it. I think it's attributed to Will Rogers or maybe Mark Twain or something. Well, clearly they are actually we are bringing more into production when we need to. It's not completely fixed yet. Change policy targets, a lot of kind of chatter, I guess. You hear this thing where climate equals carbon, carbon equals something else, and an activity equals carbon. Well, it's a way more complicated system than that, but agriculture has become viewed as part of the solution rather than only part of the problem. And if you do the math, 90-some% of the S&P 500 companies have announced some form of a sustainability plan. 2/3 of those include carbon specifically in part of a plan, whether it's a scope 1, 2, or 3, and the target and time or not varies wildly. But in general, the math is the only 3 places you can capture carbon and store it involve plants that capture carbon, the only real solar collector really. So forests, oceans, and farmland. And we're getting a lot of attention paid to see if we can use those mechanisms and channels to let people make good on their promises to be more carbon neutral. It becomes problematic when you do the actual math, the US versus the rest of the world on how much carbon is generated and how much can be sustained, but that creates an even longer term, higher pressure on farmland as one of the mechanisms to store carbon. And then low interest rates. We've had a lot of cool presentations today. Our economists who said, go borrow money now, the great American dream, get a bunch of fixed rate debt and then hope for inflation. So a lot of prior generation wealth was in fact created by having fixed income or fixed rate debt on a house, living through inflationary periods and then having a higher amount of equity when you were done. So we're going to talk about that. And then finally, is farmland yet an investable asset class? For the last 10 years, I've been wrong. I keep saying it's coming, but we've been 2 years away for the last 10 years of it being simple, quick, efficient. It's really hard to buy land, right? You got to go, you got to find it, you got to arrange stuff. They're very bespoke. You have to do things individually. It's not like other asset classes. Okay, real quickly, the scale of the asset's amazing. 2.6 trillion just in hard assets, 3.2 trillion in the sector, and only 14% debt. This long-term pattern goes decades, then just 2-year periods for the last 6 years, 4 years, sorry, to show the massive rate of growth is largely asset side. Debt as a proportion hasn't changed that much. Even in the 80s, at the height of the crisis, it really didn't get that high in aggregate. Now, individual farms had too much debt and went out of business, but in aggregate, it's not like other companies. If you take all the companies on the S&P 500, New York Stock Exchange, collapse them to a single balance sheet, it's about 67% debt. Collapse all the farms in America onto a single balance sheet, about 14% debt. So you should be able to assemble it, recapitalize it more efficiently, and capture that multiple. And it turns out it's a little harder than that. Okay, this is the mid-year USDA increases. Dave Muth will use the same charts. We build a bunch of stuff together. And this is literally as of June, and a good rule of thumb is to take those numbers and multiply by 2, and you get about the end of the year 2021 numbers for the rest of the country. So Pacific Northwest is really 20 and more than 10. Illinois is more than 13. Iowa is more than 20. So that's just the price increase. The total rate of return also includes the income that you get. So we'll break this down into more data and more data, just to give some visual around the country, where do we fit in the Midwest and the Corn Belt? The Pacific West is essentially California, a little bit more to it. Northeast is essentially not farmland, but if you take New York all the way to Maine, there is still some agricultural production, but the Northeast is really driven by population. And then what's next? Corn Belt and Lake States. So where value of production has a relatively higher gain of percent through time, you see exactly what you expect, which is farmland values go up. So if your income goes up, the asset generating that should also go up in value as well. There's some volume effects that are illustrated by this version of the same thing. Not much farmland in the mountain or the northern plains, a little bit more here. But again, if you just put on a scale relative to 1991, you see that, or think about the slope at any intervening point, you see they're all very variable. Corn Belt, though, still looks pretty positive. Okay. Again, you're going to get a little overwhelmed with data. I apologize, but these are available for you to take and print out if you want, or if there's any interest in that at all. But this is an astounding history that people sometimes don't notice. Farmland, I've assembled an index of the top 32 ag producing states and then just provided a few states that have agricultural interest. We have all of the states, and we have about 70 other assets we can do this with very quickly. But from 1991 to 2021, I picked that interval because that's when NACRE started. It's when we started having an institutionally, constantly and commonly accounted set of returns we can compare it to. Farmland, 8.6 over that entire period. Now, the last year's been great for your 401k. Stock market's done great. So did farmland. The year before, you kind of roll this back in your own mind. What happens, though, is the maximum and minimum range gives you a total amount of drawdown. The worst year in that period for the S&P was down about 50%, up about 30. Gold down 30, up 30. Farmland, hardly ever negative. A couple states where the income effect outweighed the decline in asset value effect and didn't even have a negative total return in that entire period. Crop insurance is a recent addition to some degree. Also makes it really hard to lose money in certain areas, certain years. But that range is very narrow, very low standard deviation. So an 8.6 divided by 3.7 gives you, 3.7 divided by 8.6, we gave the CV instead of the opposite one. 43% of the average in a year's standard deviation. When you get down to gold, it's 2.8, highly risky, right? Now you have specific reasons you may want gold for an inflationary effect over a specific period of time. This is not investment advice. I just want you to appreciate how well in that period farmland has done. And we always compare it to the CPI as well with the following point. Farmland is positively correlated with inflation almost no matter how you cut it. Whatever period of time you look at, whatever state you look at, whatever version of return, it's positively correlated with inflation, which now has more relevance going forward. That wasn't very interesting the last 5 years when we essentially had no inflation or very low and constant inflation. Negatively correlated with equities, although fairly low, and positively correlated with fixed income. So if you can take and the average appreciation over that period of time has been about 4.9% per year on top of the income. So these are total returns, which is income plus appreciation, less property taxes on a geometric basis so we can compound it. Kind of amazing, actually. So the punchline of these talks sometimes is, and this one's fairly quick today and a little abbreviated, the punchline often is great asset, high beta, low beta, high alpha, but really hard to get. How do we actually improve the transactional market? Turns out to be what we spend a lot of time thinking about as a result of that fact. If we were to look in the regions, which is also interesting, and I think the goal of this session was to get a little bit more around the country look and a little bit less just Iowa. And what Dave is going to give is a little bit more of the national recent look and hypothesis for what's changing. But again, the delta, 1, 5, 10, I think this is a pattern to appreciate for another reason. I think the entire economy has sort of collapsed down onto lower turnover and expected rates of return. We don't have the inflation we had in the 70s, and we went off the gold standard and our interest rates spiked all the way up to almost 20%, and interest rates on farm mortgages got up into 15 and 18%. And then we decided through a series of Federal Reserve chairs that we wanted to control inflation, and we've moved into a different world now, frankly. So I don't expect those in 20 more years, I don't expect this magnitude of number. But the pattern is that we were declining, but they're pretty safe. Lake States had a great year, and so did Corn Belt, had a great last couple of years. Pac West had a great couple of years. So yeah, these are just the 1, 5, 10, and 15-year holding periods if you aggregate those states into the same regions that NCREIF trades in. And then NCREIF has one more distinction because agriculture is defined both by what you grow and where you grow. Where you grow becomes a proxy for what you grow to some degree. But annual cropland or permanent cropland tend to be the divisions we look at most. So do you have tree nuts or do you have corn? And the annual cropland had just a phenomenal run recently. I think the long-term rates of return are more like that. Permanent cropland had a little bit of a problem last couple of years. Historic, I guess, received wisdom is that permanent cropland would generate 1 to 2% higher rate of return on average, but also have higher risk. So we're seeing that in the patterns of return here as well. Likewise, if we this one's too busy to read and too busy to appreciate, but I wanted to point out it also in farmland doesn't matter as much when you got into it as it does with equities. I have this utility where I can look at the starting point and the persistence in time of a loss or a gain. And if you look at equities, there are these splotches all over and spikes and valleys and gaps and giant wins and giant losses. And if you look at farmland, it's a really boring asset. Not quite as boring as treasuries, but it's a pretty boring asset. So they tend to have these patterns that don't have great big gaps that take you a long time to recover from, unlike equities. Again, I don't mean that one to be something I wanted you to see the numbers on. It's just there if you'd like to look at these in more detail later. Now, these are the next 3 or 4 slides are the ones that I really care a lot about. So historic inflation and interest rates, I want to make some arguments that complement. I'll go to more normal pace here too. I want to make comparisons that complement what we heard this morning from Alan and others. If we were to look at the 10-year rate, which is shown in red, all the way back to late 1960s, early 1970s, and again, if you look at this bottom blue bar, that dot is the beginning of the chart. You can look back. There were some bad things that happened in the 30s and around the wars. So from there forward, though, we have this long pattern, which is amplified here. 10-year Treasury, we got really high. We decided we're going to curb inflation. The blue line, which is inflation, I use the all-price inflation at this point. When you hit recessions, they tend to both fall. Inflation tends to fall a little faster. So each of these gray bars, you'll tend to see a decline in at least the inflation rate. So are we going to have a recession? This blue line gets to the end here, and the red line doesn't look as correlated in this last period of time that we have here. These are monthly at this point, so we don't have the final December yet for this, but this is final through November. So I give a lot of these talks, and in 2020, one of the first things I said is, in this period of time, during the pandemic, you should see everything just shrink. So I'm really proud of this. When you go back and you find something you said actually turned out to be true, you want to celebrate that, and you ignore the places where you said things that were just blatantly wrong. But this seemed pretty normal. Beginning, it was very clear we're going to shut down the economy. We didn't know what the government was going to do, but you expected kind of a decline in business activity pace and the numbers that would follow. 2021 in October, I said, gosh, I haven't actually seen a gap where the blue line is that far above the red line in my lifetime. So I was convinced they're going to come back together. I said, the question is whether Treasury rates go up or inflation comes down. And then in December, I said, whoops, they got even bigger. Okay? Since that date, again, we don't have the summary data at the Fed system. Since that date, they've begun to come back together. We started to see the treasuries move up. I checked, and the 10-year Treasury was 177 today. Had been running, sub 1.5 for a while. And inflation, we don't know how permanent it's going to be. We don't know how much of the money that we put into the economy is going to show up as inflation. So let's look at some of those numbers. In the CPI, about 15% is food and beverage, and about 40% is housing, and energy is another really big one. Not shown here because the one that used in the CPI embeds the energy as used in transportation, as used in food, and so on. You can get the core PCE with or without energy and food as well. So how did we do? Well, I think this is just actually kind of amazing. And again, this period of time here in the gray bar is essentially the beginning of the pandemic period. And what we had is energy was, bouncing around, sometimes high, sometimes low, but really dramatically dropped because we quit driving cars for a little while, right? We did some other things, but we kind of stopped our activity. Energy prices there's other things going on, but came way down, and now they've gone way back up. Automobiles tend to bounce along at about the rate of inflation. What happened? We don't want to get on buses anymore, so everybody tried to buy a car. We burned down a chip plant by accident, so we can't get new cars, and autos are way up. Now, food is the last one to look at. One thing, you see it's gotten much more variable. Cost of food at home, up, down, and then back up. Now, when you spend $100 at a restaurant and have a nice meal, you're pretty happy about it, but you consumed a certain quantity of food that came from a farm. When you buy $100 worth of groceries and take them home, that's a lot more food. The fraction of the expenditure on food that works its way back through the agricultural channel is higher if you buy it less processed. So you don't go to a restaurant, instead you go to the grocery store, the amount of money that gets back to the farmer is a bigger fraction. That makes some sense, right? So this is a positive change in terms of value of the commodity or the channel that gets all the way back to the farm. The share of food away from home down but recovering. I don't expect all the restaurants in Chicago, for example, to open back up. I really don't. But I've also learned that I can trust my order online and pick it up, and it's gotten way more convenient. I don't know where that's going to end on balance. They're kind of countervailing. A couple of other thoughts. So this is just put it all together. So let's just do some empirical stuff. Let's look all the way back to 1970 and look at the spread. So this is amazing. This is not the level. This is actually the gap over. So we have the CPI, then we have a gap over. So the U.S. Ag 32 states is a proxy for all the states, tends to be above. Again, the 85 farm crisis was largely lender-induced to some degree. We have this long period of time, 2009, during the housing crisis, I think of as a fairly sympathetic response. I went on. We have a sympathetic response. I don't think it was a real effect that was going to stay and be persistent. So that number, a decline there where everything kind of went to zero. Yeah, it happened, but I don't think it doesn't change my view. When everything's zero, I don't know what the difference between zero and zero really represents in this case. But over these periods of time, we've had a very long, fairly constant relationship. If we break it down in decades, which is roughly a good way to correspond to when the Fed chairman had different epochs of interest rate management protocols anyhow. In the 70s, we had an 11% spread, 80s, that's when we had the crisis. That's when we had farms, an embargo, international crisis or two, and so on. And then we started changing to a lower inflation, lower unemployment regime, and we've had a fairly stable pattern ever since. Long term, about 6%. That's kind of remarkable. So, given the time, I may skip through this one, but the other interesting thing in short form is that agriculture is about the only sector in the economy that we export more than we import. Okay? If you look at the balance of trade for everything else, we import TVs, we import other technology, we export more agriculture by a lot. So people often hear arguments about the strength of the dollar and the impact on the trade deficit, and you have to remember to flip that for agriculture. Just reminding you of that. And it's very country specific. So if we were to look at Mexico, and this is all expressed as foreign currency divided by US. So when it got more expensive per dollar with our big trade partners, including Mexico, that's one thing, but when it got cheaper with our biggest trade partner, China, that's another thing altogether. So we can't just look at the strength of the dollar index and look at the traded dollar-weighted index and know what it did to agriculture. We have to actually break it down with our trading partners. It's my quickest version of that. Now, this one's hilarious because before 2008, if you were to plot in time the Federal Reserve balance sheet through time, this number would have been flat all the way back to about 1950, down about half, all the way back to 1933, 32, 31. So this is the norm. Then we had a housing crisis, and we decided that we were going to allow monetary and fiscal policy to be implemented by the same people. We bought a bunch of assets from banks, Maiden Lane, tarp towel, a whole bunch of expenditures, and we thought, my gosh, we more than doubled the size of the Fed's balance sheet. That can't be good. We ran it forward for a few years, found out that the assets purchased performed pretty well, and that wasn't a terrible experiment. But now look what's happened. We have come into this and we have said, let's keep rates low by buying a bunch of bonds. And the announcements that you've heard for the last year almost now about when is the Fed going to stop buying bonds or taper their purchase of bonds or slow down their purchase of bonds to let interest rates has now been replaced with, we might actually go the other way. We might actually implement real rate changes up. But look at the scale relative to even relatively recent history of the Fed's very activist participation in monetary markets here by the scale of activities, long-term and short-term mortgages and federal issuances of Treasury. I think that's incredible. I'm not 100% sure what it means, but it looks like if you're going to put that much extra money in the economy, there should be some pressure. This is a very, very busy chart, but very, very, very useful to understand a couple of things. So along the bottom here is time from 2003 till last week, and every slice is from 1 month, 3 months, 6 months, all the way up to 30 years, the Treasury yield curve. So term structure on this front line is today's yield curve. And then we did last week and the week before and so on. And we were bouncing along, and after 2000 we had some hiccups and we got into the 05 and we had pretty high rates. And then September 19th we shut down short-term interest rate markets. And I want to build a little parallel for different reasons. I just want you to look at the pattern here and the pattern that's beginning to show up over here, post-pandemic. In this period of time, we doubled the amount of financial capital on banks' balance sheets. We implemented new versions of how much a bank had to hold in capital. We have now Basel III fully implemented mostly. And we have a whole bunch of extra risk capital in the financial systems. We're not going to get another meltdown like we had there, even if bad things happen. And the Fed tried to keep interest rates down. About all you can do is tinker with the short end of the yield curve. You can't really pull the long term of the end of the yield curve around. We finally get through that period of the post-housing crisis and say the world is normal again, and then a pandemic happens. So we get a sheer face wall. It looks very similar to that, actually. And now we're pumping money into the economy. Rather than putting it on banks' balance sheets, we're putting it in consumers' pockets, who then deposit it in the bank, and then it ends up on the bank's balance sheet. So one extra step to accomplish some of the same thing, but instead of at-risk capital, it's capacity to lend money. Again, I recognize I'm going very quickly through the argument, but I just want you to begin to appreciate the magnitude of how much of this we actually did. If you were to, this one's just for me to say, when I hear the report of the Fed's minutes, I always go print this one out and say, what does the market think the long-term rates are going to do? And you can sort of figure out what the implied forward rate looks like by looking at that day's yield curve. And so this is each of the annuals, 18, 19, 20, 21, and then a week ago. And it doesn't look like the market's terribly concerned that the long-term rates are going to explode. So I think what our economist friend said this morning is, yeah, we're going to have increases in rates, but they're not going to look like the 80s at all. Hard to find an explanation. So with all of that as background, now let's play a game. Do you want to sell me your farm? Anybody want to sell me their farm? Anybody want to buy more farmland? Most people in an audience like this want to buy more farmland. But you're also going to tell me it costs too much, right? So that we have to sort of reconcile at some point. If it costs too much, you won't sell me yours, but you want to buy more at a lower price. Me too. Let's look at this through time and see if we get any clues from what we just looked at about what we would expect farmland values to do in that world. So the 80s, again, we had a 10-year Treasury rate which was generating returns higher than farmland investments. These are just the current returns, which is just rent divided by value, excluding capital gains. Current cap rate against the current interest rate. That's all. Nothing profound. And they track really, really well until we get down to the point where we started using monetary policy again to keep the rates pretty low through a mechanism that wasn't quite the same as in the earlier years. So if I handed the data set to a physicist at the U of I and said, hey, the formula is income capitalized back to present equals asset value, what do you think farmland is worth? They come up with these three lines on the bottom, right? They say, well, the capitalized value, the light colored lines are much higher than the actual value. And I've been using this version of this chart ever since then, when they began to depart, saying, it looks like there's some pressure on land prices to go up. Looks that way to me. If I look at the rest of the economy and how much I'm willing to pay for future income, I was willing to pay that much. Farmland has some other characteristics. Again, it's hard to buy, it's a long-term asset. It's hard to just directly monetize that. But man, it got really, really frothy there. And so the last year on this scale doesn't look that dramatic to move up 20%, given how much room to run it looked like there was. And the current cap rate, this is Illinois. I should have labeled that a little differently. We have really good data in Illinois, have pretty good data everywhere else. The implied cap rate across all of Illinois right now is 2.95. So again, I don't know if that's a high or low number relative to my own lifetime. That feels like a low rate of return, but again, try teaching time value of money to students who've never had a positive savings rate. I don't know if that's a high number or not as a result. So one way to sum it all up is this. This is astounding to me. This bottom graph, and I'll tell you what the lines are. I may have to leave my white penalty box here to point at them, but this bottom graph here is the M1 money supply. I know it doesn't mean a lot, but it does mean something. And this one, just like our Fed balance sheet, if we were to track it back through time, really doesn't change much. M1 is basically the amount of money in your pocket, in your checking account, easily used to create an acquisition, purchase, liquid accounts. And we got to the beginning of the pandemic and we said, let's fill in the gap. Everything we didn't make, we're going to pay for temporarily, as though we were paying wages in lieu of what was being produced, borrowed that from the future, and we have this great big tick up. The problem is we didn't stop when people went back to work, and so now people don't want to go back to work. And we just keep pushing money through other channels into the pocket, into the bank. So then this, I like this particular group. They do some nice work, and it's published in The Economist. If you spend money from the federal government on things like roads and bridges, you end up building productivity for the future, and you get these impact on GDP from a federal tax and spend that's positive. Through the entire pandemic and then the forecast for the next 3 years, they actually have it all still negative. So it's hard to get back to the same GDP line as an economy. Agriculture separately from this, by the way. Hard to get back to that line, and most of their bounce back in GDP is actually from the inflation side effect. So I feel a little bit concerned about this, and I do agree that there's some differential pressure building than we had even a couple of years ago for lower productivity growth, at least going forward. Where does it register at the farm, though? Remember I said keep these thoughts separate. Where it registers at the farm to have highly inflationary prices are that these are the prices you can insure your crop at, 85% coverage or better in most places, all the way back to 2011, when we had a drought in 2012. 2011 was coming off of the ethanol boom. 2012 was a drought. 2013, we had no stocks, so we had high prices. Then we went from 14 all the way to 20 with pretty low prices, and now we're back up because the world is demanding oil, seeds, and corn again. So we have 557 and 1303 as of today would be the expected price for crop insurance. And if you can insure 85% of 200 bushels at 557, you can know what you can pay for your input prices now. So that seems to be a little bit exempt from some of the other sector pressures on what would happen to income, because we have really de-risked it through crop insurance. We have pretty low LTVs. There's just lots of good things here. This is just a fun tool we have at the U of I. Any day you can go on and click on it. Today I clicked on it, and it goes out and grabs all the options prices, inverts them all at once, and comes up with a probability of prices at expiration for corn, soybeans, whatever month. And so I like to look at my crop insurance decisions before we get to the crop insurance period by figuring out the probability of prices being what. Because RMA, this is also funny, by the way. Anybody from RMA in the room? RMA sets the price of crop insurance before they know what happened here. So you can end up with an insurance price that's 10 or 15 cents away from the actual price, and they don't charge you more or less for it. So you also get a free option or lose some of the insurance value on March 15th based on the fact that they can't do this in real time. Soybeans look really, really attractive at this point. 13 is a new, and Dave, I don't know if you think it's going to hold at 13, but we're kind of there now. What's that do to cash rent? Cash rent went up more than it's gone up any year for the last 10. And that's only on about a third of the acres. Most cash rent is negotiated fairly slow turnover, 1 or 2, 3 years at a time. I expect this to continue. It has a lot of momentum. Once you start increasing cash rents, it tends to increase. Once you start decreasing cash rents, they tend to decrease. It's not following income directly. It's a much slower moving process because farmers can't afford to lose acres if they have an equipment base that's distributed across those. So I think this is looking pretty positive for the landowners for a while. And for the farmer, you can use that number, calculate the probability of getting that price, and it's still pretty, it's mostly green. So we always talk about this, by the way, and we say one way of thinking about the price of farmland is this simple model: cash rent divided by your expected rate of return required for the risk minus the growth rate. Growth rate in farmland's been north of 4, but going forward, I'd say it won't be, which means for a $350 cash rent, you should pay $14,000. Here's the new kicker, though. We don't know exactly, and again, I'm going to run out of time, so I'll go quickly. I'm jump all the way down a little bit to this one, and I'll go back to that. What's a gigaton of carbon? Well, this is a picture of a gigaton of carbon over top of the National Mall in Washington, D.C. Gigaton of carbon, CO2. How much do we produce per year? About 10 gigatons in the U.S., about 35 worldwide, and we want to get rid of all of that. How many acres does that take? More than we have, okay? So what are we going to pay for it? Turns into this kind of question. If we're going to pay $50 an acre, what would that add to the value of that farmland? And as we're waiting to find out whether these programs actually get developed and deployed, some degree of that expectation is beginning to be built into farmland values as well. Don't know if it's $50 an acre, don't know if it's 2. Don't know what your cost is of capturing that carbon either. So if it costs you $49 to capture that $50 payment, it's really only a 1. If it's a straight out subsidy for agriculture's role in carbon, then it may be a 50. So I think this is another thing to begin to put into your question set. What do we think? How do we want to look at this asset class? And I do love that picture, by the way, of how big is a ton of carbon. The jokes about which weighs more, a ton of bricks or a ton of feathers. Well, then you say, how much does a ton of carbon dioxide weigh? And people go, well, wait, it's a gas, but we're measuring it in tons. And the other issue with agriculture is it's actually not CO2, it's nitrous oxide that we're paying for to remove. Anything related to nitrogen. We're getting much better technologies to manage nitrogen, including, for the farmers in the room, the PACE program, which was announced this week, insurance product for split nitrogen. We're supposed to go fairly quickly, so I'll talk through a couple of other impacts on farmland. One of them is that we're now having consumer preferences reach all the way back into the methods of production. You heard Kevin talk about his experience at University of Florida, where people are beginning to express things about the production system used in a way that actually impacts what you grow. Anybody ever heard of a Driscoll strawberry or Driscoll blackberry? Had you 5 years ago. 6 years, at some point in time recently, I didn't. If you turn over their box, there's a QR code on the bottom of every one of the clamshells. They can tell you who picked it when, in what field, what the temperature was, how it was moved. It's amazing. So now when a producer or when a consumer says, I'll pay more for those strawberries with the stems up, you can trace that all the way back into your production system, for example. In corn and soybeans, the same thing is beginning to happen. We want sustainable characteristics associated with our production. Leading Harvest, I think, I'm on the board of Leading Harvest for full disclosure. I think it's one of the groups that is fairly agnostic to how you do things that are sustainable, but becoming fairly well represented in the world, a couple million acres at this point. I think that's going to be a way of communicating to the consumer that the farmer's doing mostly what they already were doing before, paying attention to what escapes in the water, manure management, and so on. Controlled environment facilities, I think, in proximity to final use is part of the solution, but I'm not 100% sure how yet. I do know that when Sigma really impacts Southern California, you're not going to spend $12 worth of water to grow $9 worth of tomatoes. And so I expect some of the high water cost crops to be extracted from the lower valleys. You'll take all that water and put it on tree crops, no doubt, pistachios and almonds. But where do those tomatoes go? Do they go to the delta, or did they go to a greenhouse near the population that was going to consume the tomatoes? It's a great question. I think some of both. Consumer preferences, likewise, those sometimes have other problems. This is one of those. I used to have a friend that we had a contest for who could come up with the most ridiculous picture. So I would send them gluten-free peaches, and they would send me, organic water or non-GMO salt, or these are all real things. And this one just blew me away. And I should have backed away and taken a long view picture of this too. This is actually in Toronto, Canada, at a dry cleaner beside a Whole Foods. So you know where I'm going with this. So I asked the purveyor, went in, was running by and asked, what's organic dry cleaning? I don't know. So our company decided to do this. So is it different? Yeah, we have to use different chemicals. And so I went back and kind of dug into this a little bit. And I can't remember, anybody remember the name chlorofluorotetracarbon? Dry cleaning just means the chemical will evaporate at room temperature. So if you use it to wash something, you can get it dry kind of at room temperature, more or less it evaporates. A lot of volatile organic compounds are really bad for you, cause cancer. So we outlawed this one, and I think I got that name almost right. Chlorofluorotetracarbon, I think. Something like that. Well, we moved away from that in dry cleaning because it was a really bad chemical. But it turns out if you make that same product from plants, it's organic dry cleaning. So you can go back to using the dangerous chemical instead. I just find that amazing. But consumer preferences do drive, small issues drive really large outcomes. We want, if you've seen the Portlandia episode, we want our chickens to be happy and have the right amount of space and that changes the cost of production. We want sustainability though and low carbon too, and that probably adds to the income potential for agriculture. So I don't think it's all a bad story. I don't think it's all bad news. Finally, this is the last slide I'll talk about. We're supposed to end at about now. Crop insurance programs have gotten amazingly different through time. So in 1981, when they were started, they would insure 65% of production at a fixed price. That's it, yield times the price. If you drop below 65%, you got some fraction of that times a price that was generally lower than market price, because when yields went down, prices go up. It's been changed, we think, 37 times, the rating system 37 times, to the point now where you have a dizzying array. You can buy 94 different crop insurance products per acre in Illinois alone for corn. Coverage levels, type of policy, units, unit design, and crop insurance has become the thing that says you're not allowed to lose money. I don't mean that literally, but you can insure 85% of your expected production, and expected production has been trend adjusted as well. So name another industry where somebody says 85% of what you thought you could make with reasonable input prices will guarantee, and on top of that we'll pay 65% of the premium, or 40% depending on the nature of the program. So the downside doesn't look like that price distribution I showed. The downside really is kind of cut off. And then the financialization. So people who are seeing this are beginning to say, take a really strong interest in agriculture. And the number of, again, I work with NACREF closely, the number of funds that are interested in making investments in agriculture are off the chart. And global ag, the number of people interested in figuring out how to do something are off the chart. This is coming, and I've been saying for 10 years that we're 2 years away, I guess, but we're developing more and more public vehicles. There are only a couple of publicly traded companies. We have some private REITs as well. There's some adjacency funds. There's an agriculture ETF now that does things like puts John Deere plus Bayer plus. And then this decentralized finance and vehicles that let lots of individuals who don't know each other buy something together, sometimes with crypto, sometimes not. Those are starting to show up. AcreTrader had an announcement on their B round today, another $40 million that they raised. These are coming. I don't know how this is going to materialize, but they're definitely coming. And then institutional and high net worth positions have been really good for agriculture. Don't say that out loud. It's been really good for agriculture. So folks who needed to expand their production quite often couldn't do so on their own. You need another source of capital. In the long run, I think it will become low cost, closer to debt cost of capital, but in the meantime, you have to have somebody help with the expansion of agriculture. And finally, you get to the end, and it's sort of like the starting question. How many of you would like to own more farmland? Be honest, okay? How many want to sell me their farmland? There's this gap in this asset that is unlike any other asset that I know. So if I said, hey, do you have any Nike stock? I'd like to buy some. I can buy it from you by going directly to the market, and everybody who wants to sell comes up with the same price, and I buy it, and I don't know who the other side was. So the gap in that is tiny and easy to transact. But farmland has this, we heard it this morning, an emotional component and other things too. Great portfolio asset, got to be willing to be into it for a while. Great asset to die with if you are in that bracket where you want to, exhaust some of your federal estate limit. And then there are other vehicles coming online to help manage the tax associated with earning money with farmland through time. But again, that last question, I think, hard to dismiss it as being somewhat important. I'm easy to find, Sherrick at Illinois. We have Farm Doc Daily. If you haven't signed up for that, please do. We do one research article per day in the group of us at the U of I. Send it out. Doesn't cost you much time. If you don't like the headline, don't read it. If you do like the headline, read it. But we have an amazing suite of tools as well. So we have crop insurance calculators and farmland bid price calculators and just stuff there that you can find. So thank you. And if you want the long version of some of this, there's a webinar recorded at this site too that you can get to look at a much longer version of the same content. Thank you.